Welcome back to the channel. Today we'll continue our S&P Global's Deep Dive series. This time, we'll take an in-depth look into the company's history.
Yeah, we all know the S&P 500. I mean, it's the benchmark for the US stock market, right? It's the engine behind so many ETFs and mutual funds. For a lot of people, it pretty much IS passive investing. It's that number you see on the news every single night.
But here's the thing. Behind that super famous index is S&P Global, a massive $100 billion financial data giant. And its story, it's not just about an index. We're talking about a 160-year saga of brilliant acquisitions, really bold divestitures, and just a relentless, almost obsessive focus on capital allocation that built the powerhouse it is today. So yeah, let's break it down.
Okay, so before we dive in, we've got to do the quick disclaimer. Just so we're clear, this is a historical look at the company's strategy and how it evolved. It is absolutely not investment advice, and we're not going to be making any kind of forecasts. Our goal here is to understand the past, not to try and predict the future. All right, let's go.
So, here's how we're going to tackle this. We'll look at the story in 6 parts. We'll start with the original architects of intelligence and the foundational pillars. Then we'll move into the era of consolidation. After that, we'll get to the really big moves, the great pivot to finance, the decision to become a data pure play, and finally, how it became the modern data juggernaut we see today. All right, kicking things off with part 1, Architects of Intelligence. You know, S&P's 160-year history is really a masterclass in strategic transformation. It's all about how these visionary leaders used capital to buy, integrate, and laser focus on what they knew were the most valuable assets out there: proprietary data and analytics. So, that brings us to part 2, the foundational pillars. And this is key. The modern S&P Global didn't just appear out of nowhere. It actually started as 4 completely separate companies, each one born during the American Industrial Revolution to solve a very specific information problem.
So, the whole story really kicks off with a guy named Henry Varnum Poor. Back in 1860, the railroad industry was, well, it was a total black box for investors. So what did he do? He compiled the first reliable financial data into his annual Poor's Manual. Now, this wasn't just some book. It was a game changer. It created this durable, high-margin subscription model for financial intelligence that, believe it or not, is still at the heart of S&P's business today.
Okay, so while Poor's was totally zeroed in on railroads, another company popped up in 1906, the Standard Statistics Bureau. Their mission? To cover everything else. And their big innovation was less about what data they had and more about how they delivered it. Instead of a clunky, static annual book, they used a 5x7-inch card system. This meant they could send out constant updates, a huge advantage in fast-moving markets. They were already thinking like a modern data company, prioritizing flexibility and speed over just publishing a book once a year.
Now, at the exact same time all this financial data stuff was happening, you had the other 2 pillars of the story, the publishing empires of James McGraw and John Hill. Their audience was totally different. They weren't talking to investors, they were talking to the engineers and managers who were literally building industrial America. By buying up all these influential trade magazines, they figured out how to monetize highly specialized technical know-how on a massive scale. It was a completely different kind of information advantage.
And if you look at those 2 early financial data companies, you see this really interesting strategic tension playing out. On one hand, you've got Poor's, offering this deep, authoritative, but static look at a single industry. And on the other, you've got Standard, providing much broader coverage with a system that was way more flexible and up-to-date. This trade-off between depth and dynamic breadth, it's a theme that we're going to see come up again and again in the company's history.
Which brings us neatly to part 3, an era of consolidation. This is where things start to get really interesting, as these separate companies begin to come together and forge the identities we recognize today.
You can really boil this whole era down to 3 crucial moments. First, in 1917, McGraw and Hill finally merge, creating a technical publishing behemoth. Then, in 1941, the more innovative Standard Statistics actually buys out the legacy Poor's brand, and boom, Standard & Poor's is born. But the absolute masterstroke? That came in 1957, when S&P launched the product that would define its future, the S&P 500 Index.
So what made the S&P 500 so brilliant? It was all in the methodology, market capitalization weighting. It sounds complicated, but the idea is actually super simple. A company's influence on the index is directly proportional to its total market value. That's it. A simple but truly revolutionary concept that created a way more accurate picture of the entire economy.
I mean, just look at it compared to its main rival at the time, the Dow Jones. The Dow only tracked 30 so-called blue-chip stocks, and it was price-weighted. That means a stock with a higher price per share had more sway, even if the company itself wasn't that big. The S&P 500, with its 500 companies and market cap weighting, was just better? It was a more comprehensive benchmark, covering over 90% of the US market. This technical superiority wasn't just a small improvement. It created this incredibly powerful and long-lasting competitive advantage.
Okay, on to part 4, the great pivot to finance. So, picture this. It's 1966. McGraw-Hill is this publishing giant, and S&P is the undisputed leader in financial benchmarks. The decision for one to buy the other? Well, that was the single most important turning point in this entire story.
And the thinking behind it was just crystal clear. The leadership at McGraw-Hill, they were smart. They knew their traditional publishing business was cyclical. It went up and down with the economy. But financial information, that was a whole different ballgame. It was a high-growth, high-margin business with super stable, predictable revenue from subscriptions. So buying S&P wasn't just an acquisition, it was a very deliberate capital allocation move to pivot the entire company toward a much more attractive business model.
Let's jump to part 5, forging a data pure play. So for decades, the company lived this double life, part publishing, part finance. But the market started to realize that the high-growth financial side was being held back, kind of undervalued, because it was trapped inside this slower-moving conglomerate. Something had to give. A big strategic change was basically inevitable.
And that decisive move finally came in 2013. They sold the entire McGraw-Hill education division to Apollo Global Management. And the price? A cool $2.4 billion in cash. That move gave them this massive war chest of capital to fuel the company's final transformation. This wasn't a random decision. It was all part of a very specific strategy they called the Growth and Value Plan. It was pretty simple, really. Step 1, sell the education business to become a financial pure play. Step 2, take that cash and redeploy it into buying back shares and acquiring other data-focused companies. And finally, Step 3, rebrand the whole corporation to reflect this new singular focus. That's when, in 2016, they officially became S&P Global Inc., putting the power of their most valuable brand front and center. And that brings us to the final chapter, Part 6, the modern data juggernaut. Now that it was this lean, focused financial data company, S&P Global was ready for its biggest, most ambitious move yet, a move designed to cement its dominance for good. And what was that move? It was the massive 2022 merger with IHS Markit. We're talking an all-stock deal valued at around $44 billion. I mean, think about that number. This wasn't just another acquisition. This was a transformative combination, built to create an analytics and data behemoth with scale that would be almost impossible for anyone else to challenge. And the strategic logic here was just about perfect. S&P was the king of public markets data, ratings, and indices. IHS Markit, on the other hand, was a leader in deep proprietary data for really specific sectors, like transportation and energy. Plus, they had all this crucial private market intelligence. So the merger slammed these complementary assets together, gave them instant leadership in fast-growing areas like ESG, and of course, unlocked huge financial synergies.
So, that brings us to the S&P Global we see today. It's now organized into these core divisions. You've got the legacy ratings business, you've got market intelligence, which includes that powerhouse Capital IQ platform, the iconic indices division, of course, commodity insights, and the mobility data division that came over from the IHS Markit merger. It's this incredibly diversified yet somehow super focused data machine.
When you really boil it all down, the 160-year story of S&P Global is a story about disciplined capital allocation. From a 19th century railroad manual to a 21st century AI-powered data platform, the company's just relentlessly pivoted to find and monetize what it calls essential intelligence. They get that their core asset isn't just the data itself, but the absolutely indispensable insight you can pull from it, which leaves a pretty compelling question for what comes next. And that's for today's video. Let us know in the comments if you like other deep dives and new companies.